Ladies and gentlemen, good day and welcome to Q2 and H1 FY24 earnings conference call of Shankara Building Products Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vatsal Vinci from Choice Equity Broking. Thank you, and over to you.
Thank you, Yashasri. Good morning, everyone. On behalf of Choice Equity Broking, welcome to the Q2 and H1 FY24 post-results conference call of Shankara Building Products Limited. I also take this opportunity to welcome the senior management team. On today's call, we have with us Mr. Alex Varghese, CFO, Mr. Dhananjay Srinivas, Vice President, Business Development, Mr. Giridhar Parthasarathy, Manager, Accounts and Finance. Kindly refer to the safe harbor statement on the third slide of the earnings presentation. I will now invite Mr. Dhananjay for his opening remarks to be followed by Q&A session. Thank you, and over to you, sir.
Thank you. Good morning and a very warm welcome to Shankara Building Products Limited earnings conference call for the quarter and half year ended 30th September 2023. I have with me Mr. Alex Varghese, our CFO, and Mr. Giridhar Parthasarathy, our Manager of Finance. Let me draw your attention to the fact that on this call, our discussions will include certain forward-looking statements which are predictions, projections, or other estimates about future events. These estimates reflect management's current expectations about future performance of the company. Please note that these estimates involve several risks and uncertainties that could cause our actual results to differ materially from what is expressed or implied. We have uploaded our presentation on the exchange and the company website, and I hope you all might have received and had an opportunity to go through it. Quarter 2 of this fiscal year marked notable challenges for our industry. Adverse weather conditions like monsoons and flooding in certain regions and customer decisions influenced by rising inflation led to a delay in purchasing choices for the customers. Despite this challenging macroeconomic environment, we are happy to have delivered a resilient performance. Our revenues have grown by 31% year-on-year to rupees 2,275 crores during the first half of this fiscal year, aided by steady growth momentum of both our segments. Our EBITDA for the half year was rupees 71 crores, up by 26% year-on-year, while our profits after taxes were rupees 35 crores, up by 29% year-on-year. For the quarter, our total revenue was rupees 1,142 crores, up by 26% year-on-year, while our EBITDA stood at rupees 36 crores, up by 23% year-on-year. Our quarterly EBITDA margins have improved sequentially by 13 base points to 3.2%, compared to 3% of Q1 FY24, aided by an improvement in the steel mix and operating efficiencies. Our retail business grew by 27% year-on-year to rupees 1,223 crores during H1, with the same store sales increase of 23% during this period. Even with the same store base of 91, we have been able to achieve a 13% year-on-year growth in the number of transactions and a 12% year-on-year growth in the average ticket size per transaction, primarily led by the introduction of newer product categories and brands across our centers. Our EBITDA for the segment was up by 20% year-on-year during this period. While we continue to grow our retail business, we are focused to keep our costs under control for the segment, and hence our rental costs have grown by just 4% year-on-year against a 27% growth in revenues. We are in the process of opening 2 new fulfillment centers, one in Maharashtra and the other one in Madhya Pradesh, in the coming months. Given our established presence in the South, our endeavor is to continue our cluster-based growth approach and strengthen our penetration in the Southern region while gradually expanding to other regions. Our channel and enterprise business continues to be strategic for our growth. The segment has grown by 36% year-on-year during the first half of the fiscal. Given the significant focus of investment in infrastructure and real estate upcycle, we believe the segment to continue to grow steadily in the coming quarters and years. As far as our product mix is concerned, both our steel as well as our non-steel building materials have supported our revenue growth momentum, with each of these growing at around 30% during the half-year period. While we continue to hold a prominent position in steel tubes and pipes business, we are consistently focusing towards expanding our products within the steel building materials. For example, during H1, our steel flats and TMT revenues have grown at a 60 to 70% year-on-year, while our roofing business has grown by around 35 to 40% during this period. This strategy has not only helped us steadfast our business growth, but has also aided slight improvement in the profitability of our non-retail business. Our non-steel building materials continues to grow at a healthy pace. We have achieved a growth of 30% year-on-year for the first half of this year. By the very nature of the building material industry, the business activity is mostly concentrated towards the second half of the year, as the building construction activity ramps up post the monsoon period, and thus we believe we are on track to achieve a healthy year-on-year growth in our non-steel building materials during the second half of the year. Overall, we continue to remain bullish on our non-steel building materials, given the significant surge in home improvement and upgradation demand across the country. India's rising per capita income further underscores the long term of sustained consumption. We have strategically introduced our private label named Fosha Ceramica, designed to address a wide spectrum of customer requirements within the tile segment. The brand has been well received and has gained a steady traction, affirming our strategic decision in the non-steel growth. Our concept of store-in-store, starting with our partnership with one of Asia's largest paint company, Nippon Paints, is yielding positive traction. We plan to establish more such store-in-store in collaboration with Nippon and other brands in the near future. These strategic initiatives have exemplified an increase in the average transaction size and frequency of transactions at all of our fulfillment centers. We have realized that our network of fulfillment centers and our strong brand pull in the southern markets, we have the substantial market share expansion opportunity within all the sub-segments, starting from sanitaryware, tiles, electricals, to paints, and etc. Enhancing our cross-selling opportunities across all our fulfillment centers. Thus, we have been strategically revamping some of our fulfillment centers to accommodate a broader range of non-steel building materials. Our Build Pro app and website have been successfully providing customized solutions to our customers while simultaneously expanding our digital footprint. Given the nature of the industry, customers prefer visiting offline stores after conducting online research. Thus, we continue to use technology as a means to attract more customers. Our platform serves as a tool to conduct preliminary product research, ultimately encouraging them to visit our physical centers for a first-hand experience. This strategic approach has translated into an increase in footfalls at our stores. Notably, many customers who initially seek a single product online often end up making multiple purchases when visiting our centers. It's worth noting that while revenue contribution from online channel is not currently material, this transition in customer buying patterns is a pioneering effort within the industry. Furthermore, to augment our omni-channel strategy, we are evaluating suitable strategic partnerships in the digital landscape. These collaborations are aimed at enhancing our ecosystem with technology and innovation. As we move forward, we expect our revenue growth momentum to continue in the coming quarters. While we grow our revenues, we are also committed to slightly improve our profitability margins from the current levels and keep our working capital cycle under control to remain capital efficient. We are strongly working towards our ambitious target to elevate the contribution of our non-steel business to 25% within the next 4 to 5 years. As we grow this more value-adding business, our blended profitability margins should improve in the coming quarters and years. We also aim to keep our balance sheet capital efficient with our asset-light model for store expansion and efficient working capital management measures. We are continuously working towards maintaining and strengthening relationships with our key suppliers, ensuring adequate credit availability from them, and dedicatedly building a robust supply chain that enables efficient and fast delivery, optimizing our inventory levels. These efforts collectively contribute to our successful working capital management, which stands at 30 days as on the half-year end. Our return on capital employed for the first half of the year stood at 16%. Our collective efforts towards our lean balance sheet approach should drive improvement in our return on capital employed going ahead. I am also happy to communicate that we have recently received the balance payment of rupees 78.75 crores towards warrant conversion by the APL Apollo Group, further strengthening our enduring partnership for future growth. This equity infusion will not only strengthen our capital base, but also towards debt reduction and fund other operational requirements, bolstering the company's financial stability in the coming quarters. With this, I would like to hand over the call to the moderator for a Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Suresh Pal from Peace Wealth Capital Limited. Please go ahead. Mr. Suresh Pal, can you please unmute your line?
Yeah, thanks for the opportunity. Audible? Am I audible?
Yes, go ahead.
We can hear you.
Yeah, thanks for the opportunity. Sir, my question is, first question is, sir, our cash flow has deteriorated in this first half of this financial year. So can you please explain what went wrong and what might be the reason, sir?
Generally, in the second half, in the first half, say more specifically in the second quarter, overall in this business cycle has been a little sluggish. So there has been little, in collection, a little deterioration. We expect it to pick it up as we go in the next quarter.
Sir, my second question is regarding, sir, what is the effect of steel price in our business and what is the volume growth in our steel products year on year?
So the steel growth is around 30% comparing with last year.
Volume growth?
Yeah, volume growth.
Yeah, and the steel prices are fluctuating and it is having an effect. We are taking steps to, manage it in a better way.
Okay, sir. And my last question is, sir, what is our present relationship with APL Apollo? Have they divested any stake? And it is hearing that they are forming some another company named SG Mart. So will there be any chance of competition from there? So if you can throw some light regarding that, it will be helpful.
So I believe, as you said, they have invested in the warrants, which is what we expected, and we are happy with that. I would say that, as you know, the SG Mart, we don't see it as competition. I think it would be more as an additional partnership for us with them for more growth. So we are sustained and continue with our status quo and existing strong relationship and partnership with Apollo.
So they will be, it will be more like a partnership rather than competition, right, sir?
Yes, correct.
Okay. Thank you, sir. That's all from my side. I will rejoin the queue.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have a next question from the line of Soumitra Joshi, an individual investor. Please go ahead.
Hello, am I audible?
Yes, Mr. Joshi.
Yeah. So just continuing from the last individual who had asked questions, just two things from my side.
Yeah.
One is, what I am seeing is, one is on the revenue aspect of it. So can we look at a 30% plus growth at least for the next half, considering that Q2, I assume it is a slight weaker quarter as it is known, but the relative growth itself was slightly less. So can we basically take or factor in the fact that there might be an uptick in the growth in the coming quarters, that is H2?
So usually, as we say, the second half is usually much stronger in the building material industry. We believe that we do have a robust pipeline and that we can expect around maybe a...
So we are on our targets, our internal targets. So I believe we don't expect to miss our estimates.
Okay. And from a margin perspective, we are looking at an uptick because it's not. So I think it guided for about a 50 to 100 basis points increase in the year in the margins. So going forward, I'm assuming that there will be a strong focus on in H2 on increasing that EBITDA margin, which I think has been slightly subdued for the year also. Correct? Is that understanding correct?
No, I think currently EBITDA margins are expected to remain around the same level. Our aspiration is to increase it by the 50 to 100 basis points, and we are actively working on it in terms of focusing more on non-steel and also trying to improve on the product mix, and so we hope to achieve the same.
And by when would this be? Is there some? I assume the long-term target was 5% because of increasing the non-steel mix in the process, and which was about a 3-4 year down the line kind of a thing.
Yeah, that would be around, say, generally it would be around 4 to 5 years because as we have been saying this before also, currently non-steel is around 10%, and we aspire to bring it to around 25% of the overall top line. And so definitely by then we will be, if as our estimates and things go on, we should be reaching in there. Currently, in 1 to 2 years, we are focusing on actively working to improve the margin profile.
So for the next 1-2 years, you're looking at increasing the margin profile, is what you're saying?
Yes.
Okay. The last question is with this warrant conversion of APL Apollo Mart, what would be the total holding of APL Apollo Mart in Shankara?
Approximately around 6%.
5 to 6%.
So I did not understand one thing. So they had taken a few shares in the beginning. I assume it was around 4%. Then why was that offloaded in the open market and then now conversion of warrants is happening? Can you just throw some light on this? What exactly was the process here that happened?
So I think, the market knows also that Shimart, as the earlier gentleman had spoken of, I believe that they are putting out cash flows across the board to fund for that. So I believe the warrant subscription is proof enough and evidence enough that they are still committed to us and partnership of us together.
So it won't be that this will again go on to the open market, this share?
No, nothing of the sort.
That understanding is there with APL Apollo Mart?
Yes.
Okay, fair enough. Okay, so what I can summarize from this interaction is that H2 is going to be better than H1. There is going to be so we are looking at a very decent growth in H2, because one thing that I'm noticing is over a period of time, and please correct me if I'm wrong, maybe the base was lower, that is why, but the percentage of growth is also slightly slowing down. So is this something that probably will ramp up going forward, or because we used to grow at around 30, 40, 50%, and now as you can see that the growth is slightly subdued this year. So probably this is something that in H2 is going to drastically catch up. So again, the margins are remaining the same. Either we focus on the margins or we focus on the revenue.
No, so see, the focus is going to be on both margins and also the revenue. Now, overall growth, see, our this year our estimates have been around the range of say 25 to 30% only. So, and we like I said before also, we are expecting to reach our targets by the end of the year, and we do see a little pipeline that we have of orders, and you may not see a similar number of the previous year, but a steady growth is expected.
We are guided towards that 25 to 30% year-on-year growth as a CAGR, and I think we are on track to achieve that. As you say, last year would have been more robust because we were coming off 2 years of COVID, so obviously there would be a much bigger spike in terms of percentages.
Okay, and this 25 to 30% CAGR would be something of a long term, not really a 1 or a 2 year thing. It's something that we're targeting long term, correct?
This would be a long term.
Yeah, and subsequent increase in operating margins over the period of time. Is that understanding correct?
Oh, yes, thank you. Correct.
Thank you. Thank you so much. Thank you.
Thank you. We have our next question from the line of Miraj from Arihant Capital. Please go ahead.
Yes, thank you for taking my question, sir. Just wanted to understand in terms of our guidance, as we mentioned, 25 to 30% growth. How has the October month been, and if you could also give a highlight for the 10 days of November, how has the Q3 been so far?
So, I mean, we are on track. I think as we're speaking, we do have that robust pipeline as well. So it's working. And right now, as you know, this last month of October and the first 10 days of November has also been a mix with festival period. So we will see the growth coming up after probably the 15th, and we are quite bullish as per our growth for the next 5 months.
Understood, right. And so just the earlier explanation that you gave to the previous participant regarding APL selling in open market, could you please repeat that again? I missed that part.
So I think for their own cash flow reasons, they have been pulling out products, and I think the market, that's the news in the market as well. So it's really no change in the status quo as per us and our relationship with Apollo. We still have very strong partnerships and tie-ups, and then coming back into a subscription of the warrants, the firm reaffirms that.
Understood. And my final question before I get back in the queue, since we are focusing on non-steel business as well because that is a much higher margin, what are our key methods or key drivers that we are putting in place, or key some of the important acts that you are taking in to push more sales compared to steel products?
So I think one of it is that we still feel that we're at a very nascent stage. We still have a lot more potential to reach up to. Our stores are showing that same-store growth. I think the product mix as well. We are still adding the product mix with adding paints and other verticals. We are seeing a rise in ticket size for the non-steel. We have a lot more focus, as you would say, and I would say that. And we have now a dedicated team which we did not have earlier, which is also helping us drive and achieve these targets for the non-steel.
Understood. Okay. I'll get back in the queue. Thank you, sir.
Thank you. We have our next question from the line of Neeraj Lal from KCC Advisors. Please go ahead.
Hello, sir. Good morning, and thanks for the opportunity. Congratulations on the good side of numbers. So just a couple of questions from my side. You did mention in the commentary that people are more focused on visiting the stores in person rather than purchasing it online. Now, that is the case. What are our plans to improve the same-store sales growth? And is there any guidance to what will be the maximum revenue potential per store?
So, as we say, we are using our online as a discovery platform to get customers to the stores. We do see it having a slight increase in our walk-ins. I think the same-store growth currently we are at 23%, and we see that remaining steady with a slight growth in that in the coming quarters and coming years. We also believe that we are working on digital and trying to pioneer a way that customers can also buy online, and that is something that we are working in, and I think I'll have more for you in the coming quarters on that. So I think since this is something that is very new and the building material industry traditionally does not order online because of the big ticket sizes, we are working on a lot of ways to increase that and work on that. And we're also leveraging our existing customer network to cross-sell. So I think that would also be helping us drive the same-store growth.
So we can expect a change in the mix of online and retail, I guess. Am I right, sir? Is that good to assume?
See, currently our online is negligible. We are, as I said, it's more of a discovery platform. I think going forward, we will be working on this more, and then I think we could see an increase in online, but definitely we are seeing the same steady growth for the store growth and walk-ins.
Got it, sir. So just on the new, this Kosher Ceramica, what is our status on the product? What are we looking in this space, and how are we performing there?
So we found that in the tile industry there is a scope and there is a potential to bring in specialized products, newer design, something unique to the market. So we are focusing on that. We are working with multiple factories to produce our tiles, and we have gained good traction in the southern markets in projects as well as the retail space. So we do believe that the brand is growing well. And I think we have, as of last year, we achieved around 80 crores, and as on the half year, we have already come up to 50 crores. So we say that is good growth. The brand has got the traction and is growing well.
Okay. So just one last question.
Yeah.
Can you give any guidance on what will be the rental cost for the retail business, and what do we expect here, and were there any recent substantial revisions in this things?
So it will be approximately around 17 rupees per square feet. That will continue. There could be some minor increase can be there, 4 to 5%, but more or less it will be.
On an average, it will be around this. In specific areas, it may be a little higher, but in another tier 2, tier 3, if it is plus, it gets averaged on the same level.
Okay, sir. That's it from me, sir. Thank you, sir. Thank you for the opportunity.
Thank you. We have our next question from the line of Abhishek Sharma from KC Enterprise. Please go ahead.
Hi, thanks for the opportunity. Sir, my first question is related to the recent store closures. I wanted to understand the level of impact that could be witnessed on company's top line and bottom line, in the coming quarters.
So, as we have also said earlier, I think the store closure has been a strategic decision. We have not witnessed any impact on our top line or bottom line. Our same-store growths have increased and our turnover has also increased. The reason we have closed stores is at times we feel that area could be catered to from an existing store. So we would say negligible would be the impact.
Sure. My second question is just a follow-up on our launch of our in-house brand, Poshia. I just wanted to understand the rationale behind coming up with a private label in already crowded market like tiles, and how do you see this brand unfold going ahead?
We don't feel that it's too crowded. I mean, as you know, yes, there are a few very big companies that are taking care of most of the shares, but what we understand with the tile industry is there's a lot of potential and there is scope. We have had a lot of traction. As of last year, we had very strong presence in Kerala, and now we are expanding in Karnataka and other regions. We have our own designing team as well, so it gives us a USP in terms of bringing our specialized designs. We believe there is a market for it. The numbers have also proved us right. We do see continuous growth year on year, and I think we'll have more for you as the brand matures.
Sure, that's helpful. Thank you so much.
Thank you. We have our next question from the line of Suryansh from BizX Enterprise LLP. Please go ahead.
Hello. My question. Congratulations. My questions are in retail front. Sir, so like the store we are building, the store we are having, sir, so do we have capabilities to charge for display spaces to the brands? Like there are a lot of brands for same segment. So are we able to do that, or we are planning to do that, something like that?
So historically, this is something that doesn't happen in this industry. I think mostly the brand ask for the space and dealers give it to them. I think going forward, as we grow in volumes and size and walk-ins, we can leverage this as we have a big customer base and potential as well. Maybe we could see something like this coming up in the future. For now, I don't see anything changing. I think it would be status quo for the coming quarters. Maybe in the years ahead, we could think about this and leverage our strength for this.
Okay, and my second question is like when I generally go through purchasing in these kind of construction material spaces, so what I find is there are generally two kind of stores. There is one bulk material stores like cement, bars, and like then high value is differentiated. So like we have both the kind of material in same store, or we also kind of do that type of differentiation, or do we have different channels for different kind of customers and at different construction stage cycle?
So how I would say it is how our showrooms would look is we do have a space next to the showroom, which would be a shed that would usually have the steel, cement, and what you would say as the aggregate and more of the dirty products, not the beginning product, the wastage product. And we have a showroom right next to it which has the finishing product. So we have both, so customers can actually come and see both. We have, as you say, both products are very different, so they need different ambiances, and we cater to both of those in the same location.
Okay. And my last question, what are the dynamics of store in store which you are telling that you are coming up with? So like what advantage do we have, like the inventory is financed by someone who is putting the store in store, or like what are the dynamics in that thing?
So the store in store is more of it's more to signify an importance for a brand for us. So as we have ventured into the paint segment with Nippon, we have collaborated to give them space in our stores. From their side, the support would be in terms of business, marketing, and things like that. They also do give us a store promoter to help with our sales. So I think the support is more on the sales and marketing side. Inventory and other things do remain with us. But that being said, we do have low inventory required for paints because we're just starting out, and companies do have depots and warehousing across this area.
Okay. And one last question, like what I feel that there are, what I see, I don't know what is actual thing, what I see is that there are a lot of competition in very different material segments. So like we are trying to force the supplier that finance those things through them, like inventory, like it's if we are able to finance inventory through suppliers, I think we can grow fast enough and just this thing, but like if we are capable of financing through them or not.
So we work on having stronger relationships with our suppliers to get more credit facilities to improve our working capital, but I don't really see a model where they would finance inventory. I mean, this is maybe in the future this could be something that we look at. I mean, if a call to and taken is a good idea. We could see this something.
Okay. Thanks so much, sir.
Thank you. We have our next question from the line of Pooja Jain from AGM Investment. Please go ahead.
Opportunity. So you talked about the new experience center in other regions. So could you provide more color on the geographic expansion? And do you see any challenges in expanding outside the South region?
Currently we are very strong in the south, and we have a very good brand pull in the southern region. Over the last year, we have been making good inroads in Maharashtra and Madhya Pradesh. So I think for now we are looking at expansion in the west. We are also coming up with a display center in Morbi in Gujarat. So I think we are making good inroads in the western territories. We don't face any challenges because we start off with our old and legacy product of steel, kind of seed the market, and then bring in other products. So we've had a good growth, and we have a very good substantial impact last year in Madhya Pradesh and Maharashtra. So I would say that would be our next geographical territory growth, as well as reinforcing and re-strengthen and continuing to strengthen our cluster approach and method in the south.
Understood. So in continuation to the previous question, so could you also provide some guidance on the new stores, the plan for H2, and probably the strategy in opening stores in new regions?
So we don't believe we really need too many new stores. I think we are more of a strategic decision, maybe for 2 to 3 for half yearly or per year. And the reason for that is because we've seen that 23% same-store growth. We believe that there is still a lot more we can get out of the existing stores, and we can grow our revenue substantially from the existing infrastructure we have.
Understood. Thank you, sir.
Thank you.
Thank you. We have our next question from the line of Forum Makeen from JHP. Please go ahead.
Hello, sir. Great set of numbers. So I wanted to know what is the revenue contribution from APL this quarter and for H1?
Thank you. So it would be around 35 to 40%.
And this is in terms of the revenue or volume?
Revenue.
And how much volumes would we have done for H1 for APL?
Volume, just a second. I think volume would be closer to maybe 40 to 45. Just a second. So the volumes would be around 40 to 45%.
Okay. And do we expect any growth in this number for the next year?
I think as per the target we have taken with Apollo for the year and everything, we see a steady growth continuing.
Like double-digit growth?
Yeah.
Okay, sir. And so for a new brand, how are we sourcing it? Like, is it outsourced from Morbi, and do we plan to manufacture in the future?
So, as like most of the players in the industry, we also are outsourcing from factories in Morbi. So that is our current model. And I think let us see in the future. I think as the volumes go up, reviews go up, we could look at something like that in the future.
And do we plan to introduce our own brand for any of the other products like pipes and other sanitary ware products?
Oh, nothing at the moment.
Okay, sir. And so more on the store expansion. So you mentioned you would do 2 to 3 stores per year, and so all of this will be in the new areas, right? Non-south?
Not necessarily. I think it would be a strategic decision. There are some areas maybe in the southern market that have a higher projection for growth. For example, like AP or Telangana, where we are seeing substantial growth in cities like Hyderabad. So I think it would be strategic where we see the growth and where we see we can do the best.
But so won't like tapping into new geographies give us more growth? Like is it possible to sweat the existing stores to a level that our 25-30% growth will be sustained from these stores?
Like currently, basis our estimates analysis, with the existing infrastructure, we have the potential to double our turnover in the next 4 to 5 years. So our existing infrastructure in the south is at the moment strongly where there is enough potential is there. However, still, if you see a major of the revenue is coming from Karnataka and few other states. So now, say AP, Telangana, here on, we can strategically look to open few stores, and we are slowly looking even to the western region, where we'll be going with a strong hold and eventually venturing out to see what other possibilities or growth opportunities are there.
Got it. Okay. And so what is the contribution from digital business in H1?
It is negligible at the moment. It's around 1% or so. But we are looking, like we said before, we are looking at it more like an, a discovery platform over.
Are we seeing any growth in that segment?
We are seeing the growth, like I said, in terms of customer visits and obviously translating into walk-ins and footfalls in our showrooms. We are working on various strategies to increase online sales themselves. And like I said, since we are pioneering in this, it is taking some time to understand customer habits and buying behaviors.
Yes, we are studying on it to see how whether it remains steady, whether it decreases over a certain period, or whether the demand is there in a specific seasonal time or how it is. So we'll see more how it turns out in a year or so.
Got it, sir. Okay. Thank you so much.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We'll take our next question from the line of Arya from BNB Advisors. Please go ahead.
Hi, sir. Thanks for taking my question. So my first question would be, what is the strategy with APL Apollo?
In what sense, if I may ask? Hello?
Hello. Am I audible?
Yeah, you're audible.
Is there any chance APL can squeeze our margin, and what is the strategy on that front to de-risk ourselves?
We share a very cordial relationship. They have helped us grow with their wine portfolio, and we have helped them strongly penetrate in the south. We don't feel there's going to be any squeeze in margins or anything else. Everything remains status quo. We are a strategic partner for them, and they are for us. So I think we are not worried about any of those issues.
Okay, all right. And also, I would like to understand what's the aspirational gross margin and EBITDA for non-steel business?
Sorry, could you just for the non-steel business?
Yes, non-steel business.
So the gross margins are between 10 to 12% for the non-steel. And since we are still in a nascent stage and we're building our team, our expenses are a bit high. So our EBITDA comes to around 5%, 5 to 5.5%.
Okay, thank you so much.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We'll take our next question from the line of Suresh Pal from Peace Wealth Capital Limited. Please go ahead.
Yeah, thanks for the opportunity again, sir. Sir, my question is, sir, we have guided for margin growth in our overall EBITDA margin growth for the FY24, that is 3.5%. So how is the journey so far in this financial year, if you can explain?
Mr. Pal, can I request you to mute your line, please? Thank you.
So it is expected to be around 3 to 3.5%. Towards the end of the year, we'll sum up with the actual numbers out. So it is overall margin profile is seeing some improvement. However, the exact numbers we will be able to tell as things goes on.
Okay, thanks from my side. Thanks.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to management for closing comments. Over to you, sir.
Thank you,
thank you everyone for taking the time out of your busy days and to spend some time with us and to join us for our earnings call. I would like to wish everyone a very happy Diwali, and we'll see you all soon. Thank you.
Thank you. On behalf of Shankara Building Products Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.